Welcome to Note Lab Mode. Today, we're doing a deep dive into what it really takes day to day to be a startup CEO.
Yeah, we're looking past the glossy magazine covers and the big announcements.
Exactly, peeling back the layers to get at the actual, sometimes messy craft involved.
Yeah.
And we're basing this on some really insightful research we've been digging into.
That's right, because you picture the big names, the product launches, the travel,
Sure.
but the research makes a great point. You don't often imagine a Larry Page or a Mark Zuckerberg sweating the details of option pool allocations or figuring out global sales reporting structures.
But that is the job, isn't it? A huge part of it anyway, the unseen stuff.
It absolutely is. And the core idea here is that it's a genuine craft, something you mostly learn by doing it, often the hard way.
Like that blog name the author used only once. Captures that first-time CEO feeling perfectly.
It really does. And their whole goal with sharing this research, based on 14 years of experience, is to maybe help other entrepreneurs avoid some of those classic pitfalls.
Like getting fired, or the company just failing.
Or just spinning your wheels, not really understanding the role, paying it forward, essentially.
So people often talk about that simplified framework, right? Like Fred Wilson's idea. A CEO does three things.
Yeah, the classic three. Set the vision and strategy and communicate it constantly. Recruit and keep the absolute best people. Make sure there's always enough cash in the bank.
A solid starting point.
Definitely. But the research we looked at builds on that. It expands it. It says, well, execution is more than just managing cash. It's about making things happen.
Yeah.
And it adds two other really critical areas. Building and leading a board, which is its own skill and maybe the most overlooked part. Managing yourself.
Ah, that makes sense.
Yeah.
So it's a more holistic picture of the craft.
Exactly. That's the expanded view we're exploring today.
And this deep dive is brought to you by Cloudfit.ai. Cloudfit.ai connects influencer outfits directly to your product inventory. What this does is make their content instantly shoppable, driving more sales and, importantly, higher average order value for you.
That sounds pretty powerful for e-commerce.
It is. To learn more, just visit cloudfit.ai. That's CLOUTFIT.AAI.
Okay, so where do we start? The research puts a huge emphasis on building the company's human capital, which naturally begins with recruiting, getting the best talent.
And your role as CEO in that changes as the company gets bigger, doesn't it?
Totally. Early on, you might be the final interviewer for almost everyone. Later, it's more focused on senior execs.
Though candidates still really value meeting the CEO, right? It sends a signal.
Oh, absolutely. It gives them a direct feel for the vision, the culture, the leader. But here's a critical piece the research really hammers home: reference checks.
Not just the ones they give you.
Exactly. Those informal or back-channel references are crucial. It's incredibly easy to get, suckered in by a polished resume or a great interview.
Yeah, I can see that.
And just because someone was a rock star at a huge established company doesn't mean they know how to build something in a chaotic startup environment. You need builders.
That reminds me of that anecdote in the research. The person from the Fortune 500 company asking where the typing pool was on day one.
Yes. A perfect, if maybe extreme example. Total red flag. Startups need a different DNA, a tolerance for ambiguity,
So the CEO needs to be kind of always recruiting.
Constantly, always in market, meeting interesting people, even if there isn't a specific role open right then. It's that whole get the right people on the bus idea, find great talent first, figure out the exact seat later.
What about sales leadership? That feels like such a make or break hire. When do you pull the trigger on that?
The research suggests it really depends on the business model. If you need customer commitments or partnerships before you launch, you need sales involved months ahead.
Okay.
If you, as the founder, are a natural salesperson, maybe you can carry it longer. But there's a clear warning sign.
What's that?
When you find you're not getting back to really valuable prospects within, say, a business day because you're swamped, that's a danger zone.
And if you suddenly panic and think, I need a head of sales right now.
The research says you're already too late. You needed them before that point of desperation. They need time to build.
That makes a lot of sense. So when you were interviewing, what's the approach? The research mentioned something. 2 ears, 1 mouth.
Yeah, simple but powerful. Listen way more than you talk. Don't just sell them on how great your company is. Ask good questions.
Like,
A really effective one mentioned is just, so what do you think of our business?
that cuts right to it. Shows if they've done their homework, if they're actually interested.
Exactly. Tells you a lot about their preparation and genuine curiosity. Why hire someone who isn't curious about what you actually do?
Good point. Okay, so you hire someone great. What about onboarding? Getting them started right.
Crucial. The research recommends having a solid orientation deck ready for day one. Covers the mission, the values, the strategy, the structure, and ideally the CEO presents at least part of it. Sets the tone.
And setting clear goals for those first 90 days, not just letting them drift.
Absolutely. Concrete objectives, so their first quarter is intentional. And then you need a review process at the end of that 90 days.
To see how it's going.
Yeah, 360 feedback, manager review, whatever fits. But that's the window. It's much, much easier to address fit issues or performance concerns, or even part ways if necessary early on. Later, it just gets harder.
Okay, so they're on board and settled. Then comes managing teams, compensation, that whole piece.
Right. The research breaks startup comp down into 3 core parts: base pay, incentive pay, like bonuses, and equity. All 3 need attention, annually at least, especially for the exec team.
Any rules of thumb? Like for the equity pool?
It mentions around 20% fully diluted is pretty typical as a benchmark. For sales comp, the key is aligning individual goals directly with company revenue targets. That seems to work best.
Makes sense.
And it shares an interesting story from ReturnPath, where they actually eliminated bonus targets for most employees, except senior execs in sales.
Really? Why?
They decided to raise base pay instead and focus management energy on setting ambitious stretch goals and dealing directly with underperformance. Kind of bold.
That is bold. Shifting the motivation. What about promotions? That can be tricky. Avoiding the Peter principle.
Definitely. Having clear criteria is vital. ReturnPath apparently used levels like learning, applying, guiding, shaping, so people knew the path.
Provide structure.
Yeah. And there's this cautionary tale about a star sales rep who desperately wanted to be a manager. They pushed, got the role.
And it didn't work out.
Nope. Wasn't the right fit. They eventually left. It's a reminder that great individual contributors don't always make great managers, and forcing it doesn't help anyone.
Tough lesson.
Uh-huh.
So keeping and growing talent isn't just about titles. It's about the work itself.
Absolutely. Letting people focus on high-impact stuff, solving hard problems, and believing in transferable talent. Yeah. Letting a strong performer try a role in a totally different part of the company, maybe with some coaching or support. The alternative is losing them or only ever hiring specialists from outside, which sends a bad signal about internal growth.
Okay, so you've got this great team. How do you actually get things done? This brings us to execution, bringing the story to life.
Right. And startup business plans, the research stresses, are fundamentally different. They're short, they iterate, they're built on hypotheses you assume are wrong until you test them.
So no spending 6 months perfecting a plan in a dark room.
Please no. Test things in the market quickly. But you do still need financials, even projections, especially for investors.
Not because the numbers are perfect, but
to show you understand the drivers, that you know how the business makes money or loses it, and how you'll manage around cash.
Got it. Evaluating the ideas themselves is part of execution too, right? That analog thing.
Yeah, finding the offline parallel, like return path, seeing email, change of address as the digital version of mail forwarding, or list rental, like direct mail lists.
Or finding that simple innovation, the wheel.
Exactly, like wheels on luggage. Seems obvious now, but it transformed the market. Simple, powerful innovation.
But a big market isn't enough on its own.
Definitely not. The research adds 2 crucial questions. Can we win? Meaning, does our team have what it takes to execute? And economics. Is there enough funding? Is the model viable? Just saying this could be huge is dangerous if you ignore those.
Makes sense. And defining mission, vision, values. That's presented as non-negotiable for alignment.
Absolutely essential. The research talks about return path involving the whole company and defining theirs, using an HBR framework, so it wasn't just top-down.
The values need to be concrete.
Yeah, things like do the right thing, which meant transparency, spirit of the law, or succeed together, meaning collaboration, learning loops, they guide actual behavior.
How do you motivate people if you're not, curing cancer?
The CEO's job is to connect the work to impact. Explain the purpose. Maybe you enable billions of emails people wanted to get, like the return path example. Maybe you're helping someone else who is curing cancer or doing other vital work. Find the meaning.
It's about context.
And symbolism matters hugely. Leaders are watched constantly. The research gives examples.
Oh, yeah, the auto CEOs flying private jets for bailout money.
Exactly. Or Scott Thompson's resume issue at Yahoo. Or Caroline Kennedy's voting record. Small things can erode trust fast. You're in a fishbowl.
Okay, so strategy, knowing when to stick with it versus when to change course, That sounds like art and science.
Totally. You need to watch the signs. Is the data just not backing up your thesis? Are results consistently poor? Are you always in startup mode, burning cash endlessly? Is there just constant internal chaos and firefighting?
Those are red flags.
Big ones.
Yeah.
Return Path apparently expanded based on a wrong assumption about buyers and had to refocus, even divest parts of the business later. It happens.
And the CEO's role in strategy changes too, from figuring out the basics early on.
To later needing to constantly filter and prioritize which opportunities to pursue out of many, saying no becomes critical.
Okay, let's shift gears. Cash. The research calls it oxygen.
Fundamental. It's the #1 reason startups fail. They just run out of money, period.
Which means your strategy has to be realistic about your funding.
Absolutely. You can't chase 5 huge goals if you only have cash for one. Alan Masrick's point in the research is key. Pursue a strategy you can actually fund through the next milestone. Otherwise, you die trying.
And the CEO has to own financial discipline.
Has to lead it. Accuracy, timeliness of reporting, setting the tone for paying vendors. It starts at the top.
It's probably hard to suddenly manage millions if you're used to your personal bank account.
It's a learned skill. The research mentions that. Developing an instinct for large numbers takes time and focus.
Which connects to that boiled frog idea, spotting problems early.
Exactly. Cultivating that inner paranoia, noticing the subtle signs before they blow up. Is a key person maybe interviewing? Are there quiet complaints about someone? Business vulnerabilities you're ignoring? Cash gives you options when things go wrong.
Speaking of cash, funding options. The research warns about dumb money.
Yeah, especially when it floods a sector. Money backing unsustainable models like giving away core services for free can kill healthy competitors. Look at the intelligence of the money, not just the competitors' actions.
What about debt?
Usually for more mature businesses. Convertible debt is common early on from angels or VCs. Personal debt, credit cards, mortgages, that's the startup romance, but carries huge personal risk. Bank debt almost always needs personal guarantees.
And navigating VC term sheets? Sounds like a minefield.
Get a great lawyer specializing in venture deals. That's rule 1, not your buddy who does real estate.
Okay, what terms really matter?
Valuation, obviously, but also the type of security, the option pool size, board seats, and your own rights and comp package. Sometimes sacrificing a bit on valuation for a cleaner structure is smart.
And the most important advice.
Always have a BT&A, your best alternative to a negotiated agreement. Know your plan B. It gives you power.
Makes sense. What else on VCs?
Don't just accept that's how we always do it. Ask why. Be willing to pay up a bit in terms for truly high-quality investors who bring more than cash. And check their references relentlessly.
Ask for CEOs they fired.
Yes. See how they act when things get tough. And if you have multiple VCs, push for a single investor council and a clear lead investor. Keeps things simpler.
Forecasting seems critical too, especially in downturns. Return Path's 2008 experience.
Yeah, insightful. They predicted higher churn, price pressure, but missed how long big customers would take to pay. They ended up financing Fortune 500 companies.
Ouch.
Meant they had to reforecast constantly, especially cash flow. Monthly even. You have to stress test your core revenue.
Okay, beyond VCs, there's the board of directors.
Yeah.
Often seen as intimidating.
The research argues they should be an asset, not something to dread. A good board can be a forcing function, pushing you to hit deadlines, make hard calls.
Better than just an advisory board.
Generally, yes.
Right.
More formal, more accountability. And Bradfeld's point is key. The CEO sets the tone. It's not just reporting up, it's a strategic dialogue you lead.
So what makes a board member great?
Preparedness. Speaking their mind even when it's tough. Building relationships with each other and management. Bringing broad experience. Staying strategic but out of the operational weeds.
And finding them takes effort.
As much effort as hiring a top executive. Source broadly, interview many, check refs thoroughly, maybe have finalists sit in on a meeting.
Running the meetings well is key too, right? They're expensive time-wise.
Absolutely. Use a consistent format, a board book, financials, metrics, progress, key issues. Focus on discussion.
The research mentioned a time allocation.
Yeah, like for a 4-hour meeting. Minimal time on official stuff and looking back, maximum time on forward-looking discussion and the closed session.
And encouraging your exec team to connect with the board.
Very valuable. Building those direct relationships helps the board understand the business better and gives your team exposure and strategic input. Anita Absey's perspective in the research highlighted that.
And the value isn't just in the meetings.
Right. The ad hoc calls, the prep, the informal chats all build trust. And serving on other boards. Scott Petrie's point was that it gives you invaluable perspective on your own CEO performance.
Seeing things from the other side of the table. What about independent directors?
Important for bringing a purely company-focused perspective, not tied to founder or investor interests.
The research also covers M&A and divestitures. Not just growth, but shaping the company.
Yeah, M&A is a strategic tool. Return Path did over 10 deals. But divestitures, selling off a part of the business, can be just as strategic, though complex.
Hard to untangle things and hard emotionally.
Definitely. It often means admitting something didn't work. And being transparent with employees whose jobs are uncertain is incredibly tough, but necessary. The authentic response divestiture story highlighted that.
And integration is where acquisitions often fail.
Huge challenge. Key areas are people making tough calls humanely, product development actually delivering the combined vision, product management handling legacy stuff, and IT systems start planning early.
Okay, let's move to the CEO's direct skills.
Hmm.
Communication and that crucial piece, managing yourself.
Communication is fundamental, and it's not just talking, it's being heard. Knowing your style, maybe getting help from a comms pro as you grow.
And remembering you're always being watched. The fishbowl effect.
Totally. Every action sends a message. Emails on vacations signal expectations. Even using a blog or social media can attract talent who resonate with your style and culture.
Internal communication builds that culture, creating moments.
Yeah, don't let good stuff go without saying. Mark anniversaries, celebrate wins big and small, institutionalize peer recognition.
Like those return path acronyms, EEABCD.
Exactly. Everyday excellence, above and beyond working out of title. Fun ways to reinforce desired behaviors.
The research also touched on physical office space versus remote.
Acknowledging the trade-offs. Proximity aids spontaneous communication, productive eavesdropping. Remote requires more intentional communication structures.
Feedback is another big one. Getting it and giving it.
Essential. Different types. Performance feedback versus first step. Clearly articulate the problem. Don't sugarcoat. Then, talk through solutions with trusted people. It refines ideas fast.
And manage the team's emotions.
Crucial. Leadership counts double in a crisis. You can make leaps then, but constant crisis burns everyone out. Finding that balance.
Which leads nicely into work-life balance. Or maybe integration.
Yeah, the research prefers integrated entrepreneurial life. It's not about perfect balance, but self-discipline, flexibility, constant reprioritizing, maybe using that simple matrix. Serious, not serious. Time critical, not.
Yeah, and the reminder that if the business wins, but your life falls apart.
You haven't really won. Danny Meyer's idea of integrating body, mind, heart, spirit, it's holistic.
Any specific tactics mentioned?
Unplug vacations annually, the building won't burn down. Weekends with friends, using commutes for personal reading, having outside interests. Learning to say no, the French fry theory. You can always squeeze one more thing in, but should you?
That time for myself is actually productive.
Absolutely. Being out of touch sometimes is okay. And finding meaning beyond money leads to better performance and satisfaction. If you feel you have no impact, maybe it's the wrong role.
Learning and adapting seems to run through everything.
Constantly, benchmarking against peers helps find problems or validate ideas. Postmortems after big events, good or bad, institutionalize learning.
Like the military uses them.
Exactly, and embracing failure, not just saying it, but doing it. Laura Mather's fundraising story is great. Mistakes are like security guards telling you where the problems are so you can fix them fast. Failures have fathers, understand the root cause.
And competition. Don't just play defense.
Turn it into defense plus offense. Use custom work as prototypes. Change the value proposition instead of just matching feature for feature in an endless arms race.
Wow. Okay, so wrapping this deep dive up, it's clear being a startup CEO is so much more than the public perception. It really is a learned craft.
Absolutely. It demands focus on people, money, execution, boards, communication, and definitely on yourself and your own learning.
It's about that relentless day-to-day work that turns the vision, the story, into reality.
It really is. So maybe a final thought for you listening. Reflecting on all these different facets of the CEO craft we've discussed based on the research, which part resonates most strongly with you right now? And maybe what's one specific action, however small, you could take this week to actively practice or improve that part of your craft?
That's a great question to chew on. Thank you for joining us on Note Lab Mode for this deep dive.
And thanks again to our sponsor, cloutfit.ai. Remember to check them out at cloutfit.ai.
If you found this valuable, please do share it with a fellow founder, leader, or anyone interested in the realities of building a business. And of course, subscribe so you don't miss our next deep dive.